take a look at Chapter 1, the role of accounting in business. So we're going to take a look at the types of businesses, how they make money, the 3 business activities, what is accounting, basic financial statements, and the concepts. So learning in Chapter 1, we're going to take a look at the types of businesses. So the types of businesses. So first type we're going to look at is a service business. So the example there is Delta Airlines. They provide you the service of flying on their airplanes. Manufacturing business, an example is General Motors. General Motors manufactures the cars and sells them to you. The difference between the two is Delta doesn't manufacture and sell you airplanes. Delta sells you the service of flying, where General Motors manufactures the vehicles and sells them. Then a merchandising business would be Walmart. So Walmart buys televisions from Samsung and sells them on their shelves. So the different forms of business. So we have a proprietorship, partnership, corporation, and a limited liability company. So a proprietorship would be a single person operation. So my example is always Joe's Lawn Service. Joe's an individual. He wants to buy a couple lawnmowers, start a little lawn service, where he's the only owner. Partnership, where Joe wanted to get with John, and they wanted to be equal partners in a lawn service. Corporation would be like a Walmart, where they're publicly traded, they sell stock, and the corporation serves as its own entity. And then a newer entity is a limited liability company, or an LLC, where you get the limited liability advantage of a corporation, but it's a little bit easier to form. So some considerations. Ease of formation. If you're just Joe's Lawn Service, you don't want to have to file a bunch of paperwork and hire lawyers and form a complex business. The ability to raise capital. How much money do you need? If you need a lot of money, maybe a corporation's good because you can sell stock and raise a lot of money. Legal liability. Corporations and LLCs give you limited liability, which means that a creditor or a lawsuit can only come after the assets of the business, not the personal assets of the owners. Taxation is important in any business decision. And limitation on life. How long is it going to go? So let's take a look at some of the differences. So if we see from ease of formation, the most complex is a corporation because of all the paperwork that has to be filed with the state. Where partnerships and proprietorships are pretty easy. Legal liability we talked about, where it's limited with a corporation and an LLC, limited meaning limited to the assets of the business. Where a proprietorship and a partnership means somebody could come after the personal assets of the owner. Corporation is the only one that's taxable on its own. The proprietorship, the partnership, and the LLC, the profits and losses flow to the personal tax returns of the owners. And then all of them are expected to have a limited life except a corporation. A corporation is expected to go on forever, whereas the other 3, if a member, a partner, or the sole proprietor passes away, it ends. And if we look at capital, with a proprietorship, it's pretty limited because it's one person and how much money they want to put into the business. Partnership and LLC, you get more partners, you get more members, you could raise more money. And a corporation's extensive because you could sell stock. So how do businesses make money? Well, they provide goods and services to customers to make a profit. 2 ways to do it: premium price and low cost. So a good example is if we look at the hotel example. So Ritz-Carlton is a premium price strategy. It's high quality, a lot of amenities. Where Super 8 takes the other approach. Not quite as many amenities, not quite as nice, but it's a lower cost. So the stakeholders in the business. So we have our capital market stakeholders, which are people like the banks, the owners, our stockholders. Our product or service market stakeholders, which would be our customers and suppliers. Government stakeholders, federal, state, and city governments. They always have to be considered, and taxes and fees are a part of every business decision. And internal stakeholders, employees and managers. So let's look at the 3 types. So we have investing activities, operating activities, and finally financing activities. So investing activities is acquiring the assets, operating activities are using the assets, and financing activities could be seen as gaining the funding to acquire the assets. So you can see it goes in a circle. So what is accounting? Accounting, the language of business. We generate reports to talk about the economic activities and condition of a business. So we're summarizing the financial performance of the firm for external users. What are the objectives of financial accounting? The first one is the financial condition at a point in time, and then the financial condition over a period of time. So let's take a look at the financial connect together. So we have four major financial statements. We have an income statement, which is the summary of revenues and expenses over a period of time. We have our retained earnings statement, which show changes to retained earnings over a period of time. We have our balance sheet, which is a snapshot of assets, liabilities, and owner's equity at a point in time. Then we have our statement of cash flows, which shows the changes in cash flow in investing, operating, and financing activities over a period of time. So first, let's look at the income statement. So if we look at the Hershey Company, the year ended December 31st, 2010. So that means this income statement is from January 1st to December 31st, 2010. We see we had $56.71 in revenue, $51.61 in expense, so our net income was $510. So we're showing our revenue and expenses for a period of time, which in this case is a year. And this is the change in financial condition due to the operations. So we have revenue in operations, we incur expenses, and we generate revenue. The matching concept. We should have expenses to match the revenue in a period of time. And then if we subtract expenses from revenue, we get net income. Our retained earnings statement, so let's take a look at the Hershey Company again for the year ended. So our beginning balance at January 1st was $41.48. And then we add our net income of $510 to retained earnings. We subtract dividends of $283 that we paid to our stockholders. And our net increase is $227, which is $510 minus $283. If we add the $227 net increase to the $41.48 beginning balance, we get an ending balance of $43.75 in retained earnings. So we're reporting changes in retained earnings during a period. And retained earnings is defined as the portion of net income retained by the business. So we started out with $41.48 of net income retained by the business over time. That's a balance, a snapshot at January 1st. We're retaining $510 in net income from 2010. We're giving $283 of the net income back via dividends. So in net, we're retaining $227 of net income for 2010. And if we add that to what we had to start with, the $41.48, that's how we get to our $43.75. So let's look at the balance sheet. So if we look at the Hershey Company, we see our total assets, total liabilities, total owner's equity. And this is a snapshot in time of these balances on December 31st, 2010. So we see that our total assets equals liabilities plus owner's equity, which means the assets equal the claim to those assets. Assets equals liabilities plus owner's equity is also known as the accounting equation. So let's look at preparing a balance sheet. So we list the assets in their balances, we list the liabilities in their balances, we list the stockholders' equity items in their balances, we add up liabilities and stockholders' equity, and that should equal total assets. Finally, the statement of cash flows. So we look at the Hershey Company again, year ended December 31st, 2010. So for the year, we had a $901 cash inflow for operating activities. We had a $199 cash outflow for investing activities because you see we bought some property, plant, and equipment, and then we sold a little bit, and it nets out to a $199 cash outflow. For financing activities, we had a $71 cash outflow, negative 71. So if we add the 901 less 199 less 71, we had a $631 net increase in 2010. If we add that to the beginning balance, we get our ending cash balance of $885. So we're reporting the change in financial condition due to changes in cash during a period. So we have our operating cash flows, investing cash flows, and financing cash flows. So let's take a look at operating activities. This is reported first. And this is what stakeholders like to see, because operating activities are the ongoing activities of the business which generate revenue and expense. The acquisition of products and services and the sale of those products and services. So if we look at Walmart, what are operating activities? Operating activities are acquiring goods to put on the shelf and selling goods that are on the shelf, and that's the core business of Walmart. Investing activities, it's always reported second, and this is the cash receipt from selling property, plant, and equipment. So if we sell our plant in Georgia for $500,000, that's a positive $500,000 cash inflow. And it's also the cash used to purchase property, plant, and equipment. So if we buy a plant in Florida for $1 million, that's a negative $1 million cash outflow. And it's common to have a negative cash flow for investing activities, because if you're growing your company, you're buying property, plant, and equipment, you're spending money to buy that stuff. Let's look at financing activities. It's reported third. And this is cash from issuing debt, which would be bonds or loans or stock. So if we sell $1 million worth of stock, that's $1 million positive cash inflow for financing activities. And then if we pay dividends on that stock, that's a cash outflow. So if we pay $200,000 of dividends, that's a negative $200,000 cash outflow in financing activities. So let's see how these all connect together. So if we look at our statement of cash flows, we have our ending cash balance of $885. That is the cash balance on the balance sheet under the cash asset. If we look at our income statement, we come to net income of $510, and we bump that into our retained earnings statement, where we take our beginning retained earnings plus net income less dividends to get our ending retained earnings balance. We take that ending retained earnings balance of $43.75 and put it in the stockholders' equity section of the balance sheet. So statement of cash flows is linked to cash, ending cash. Net income goes into the retained earnings statement, and then when we calculate ending retained earnings, it goes to the stockholders' equity section on the balance sheet. So let's take a look at the 8 accounting. So these are the rules. So we have our accounting concept, business entity, cost concept, these on the bottom, and those roll up to generally accepted accounting principles, which you could kind of say are the rules of accounting. And then we use those rules of accounting to generate the 4 financial statements. So generally accepted accounting principles, which is also known as GAAP. Now let's look at the 8 concepts. So our first concept is the business entity concept, which means that the economic data recording into the accounting system is just the activities of that company you're reporting for. So that means that the company is separate from its owners, its creditors, or other companies. So if you're reporting financial data for Walmart, you're just reporting data for Walmart, not Walmart's creditors, not their suppliers, just Walmart. The cost concept means that the business's assets are recorded at their cost or purchase price. The going concern concept means that there's an assumption that a company will continue in business indefinitely. The matching concept means that the revenue a company generates should be matched against the expenses incurred in generating those revenues in the same period. So a better way to put that might be that expenses are matched against the revenues they generated. The objectivity concept requires that anything recorded on financial statements should be based on verifiable or objective evidence. So what that means is you can't just make an entry into the accounting records because you feel like it. There has to be some kind of evidence or backup documents supporting those entries that you make. The unit of measure concept means that in the United States, everything has to be recorded in dollars. If you're recording somewhere in Europe, maybe it's a different concept or different currency. The idea is that it has to be consistent. The adequate disclosure concept means that the financial statements include anything that a stakeholder would need to understand the financial condition of the company. So the idea here is that if you know you have a big piece of debt, you can't withhold it from the financial statements. You have to adequately disclose things in your financial statements. And the accounting period concepts means that accounting data is recorded and summarized in periods of time. So if we looked at those Hershey's financial statements, it was for the year 2010. It was an accounting period. It was a period of time. And that's the end of Chapter 1. So in addition to this, you have your Chapter 1 homework. We will have an example that will also be narrated. And please let me know if you have any questions.